Thank you for joining us today. My name is Vicky Churcher and I'm one of the co-chairs of the IPTF, the Income Protection Task Force. It was almost a year ago to the day that the Consumer Duty came into force in our industry for open products and services. Today, we're going to take some time to reflect and discuss how this game-changing initiative has reshaped businesses, behaviours, and essentially how it has helped customers. This session will be around 35 minutes, and the good news is it does count toward your annual structured CPD requirement. And I'm delighted to be joined today by Keith Reichards, CEO of the Consumer Duty Alliance. And to ensure we are representing the whole protection industry, we also have with us today an advisor, Michelle Grant from LifeSearch, a representative from an insurer, Jamie Page from the Exeter, and a key industry value-added services provider, Steve Casey from Square Health. Each have considered from their own perspectives what's important to them and will pose some relevant questions to our guest speaker, Keith Reichards. So let me start by asking you, Keith, can you just share with us a little bit about your background and how the Consumer Duty Alliance came about?
Great to be here, Vicky, and thank you very much for asking. My career started, I'm going to give my age away, over 40 years ago, before regulation as we know it came into effect in the mid to late 80s. I started my career actually as an advisor, but very quickly went on a management development program and have had senior roles across the sector. Much of my early career was around insurance and protection. For example, I set up protection sales forces. I run a large sales force. I was head of retail for Royal London Group as an executive on the retail board. I ran what was at the time one of the biggest networks and support service groups in the IFA market, Tenet Group. And just after the retail distribution review, which was the Armageddon of all regulatory Armageddons, or allegedly, I took over the role as Chief Executive of the Personal Finance Society, which I then led for just over 8 years up until 2021, when I then stepped back to start some pro bono work. And that led me then to start, I became chair of something called the Financial Vulnerability Task Force. The objective of that was to help the market better understand the requirements of the regulators' rules around vulnerability, to put them into plain English, basically, for the sector. Through member demand, that task force grew to around 4,000 intermediaries pretty quickly, and of course, not long after the FCA's rules in 2021 around vulnerable customers came, of course, the rules that were being set, the consultation around consumer duty, and of course, vulnerability is wrapped into consumer duty more broadly, and we'll probably get on to what that really means. So we formed the Consumer Duty Alliance back in March of 2023. Since then, we've been overwhelmed by the level of engagement from across the market, not just the financial advice sector, but across insurance and even banking now is very actively engaged, as consumer duty really affects every single part of retail financial services and effectively is a game changer. So the whole objective of the Consumer Duty Alliance is an independent, not-for-profit, and very importantly, has no commercial activities or output. Its ultimate goal is to support the market in the delivery of consumer duty by sharing good practice, experience, and importantly, signposting off to well-established firms that can offer support or services across the market. Our other role is engaging with policymakers. So we're very actively engaged with the FCA and Treasury. And ultimately, our goal is to see how we can augment the real value of professional advice more broadly in the consumer space.
Thanks, Keith. That's really interesting. That actually leads us quite nicely on to probably a good opening question for this session is, can I ask you to share with us why the FCA actually introduced consumer duty, and essentially who in a firm is actually responsible for understanding and observing the consumer duty principles?
Yeah, they're great questions, and I think the whole market is now starting to understand that Consumer duty is quite a significant set of a change of direction for the regulator. So the FCA's consumer duty represents what the regulator terms as a paradigm shift in its expectations of firms. So the rules have set a clear expectation for the standard of care firms give to consumers in retail financial markets. From our perspective, we believe it's always been the professional standard of good firms and good advisors. In other words, we've now seen a shift from prescriptive rules-based regulation to outcomes-based regulation. So if we think of it more simply, when it was prescriptive, it often felt frustrating because the rules, prescriptive rules, often didn't feel appropriate for good firms. It felt that we were being victims by regulators introducing rules around the lowest common denominator, so good firms got impacted. When it's outcomes-based, it's totally different in that effectively it allows every single person in an organisation. So this shifts away from the responsibility of compliance to decide what the rules are, to create a tick box kind of culture, which we have seen develop over 35 years, into an outcomes based. And that means everyone from product design through to front end delivery has a responsibility for the outcomes of the products or the services they provide. And frankly, ultimately to your second part of your question, it's the responsibility of the CEO and the board of the company to ensure that outcomes is absolutely part of the day-to-day strategy and operations of any organisation.
1 year on, how has the success of consumer duty been evidenced and demonstrated in general?
Yeah, another great question. Credit to many firms and individuals who've been recognised by the FCA in the FCA's own updates. In December, when they did a webinar for the market to connect, they did a written update, which anyone can get off of the FCA website back in February, where they gave examples of good practice and actually really interesting terminology from the FCA where they then reference not bad practice, but where firms could do better. In other words, the starting point here is most firms are accepted to focus on delivering the right set of outcomes for their customers or clients, but they may not always be able to evidence it. And what the FCA are really giving us now is a lot of clear focus around examples of good practice. So, for example, when you look at culture and conduct in a firm, so the problem that the regulator has seen, which is why we had things like the SM and CR introduced after the banking review, is it was felt that senior executives and managers in firms didn't necessarily take full responsibility for the outcomes of their organisations. What they realise is when you use rules, it creates a different culture. I've already mentioned prescriptive rules tend to create a tick box exercise. So now what's really interesting is the regulator has given an example on culture where they say they've seen evidence where from the board, full discussions around consumer outcomes at board level, clear signposting in their organisation right the way throughout the organisation that there is a paradigm shift towards outcomes-based focus, training of their staff, and they give a number of other key examples of where firms are really starting to understand how they can deliver against the expectations. Now, the flip side of that, they give an example of where firms could do better, and guess what? The example is where they've seen a firm where it's not discussed at board level, it's simply been passed across to the compliance team or compliance and risk team or a project team, whilst the board can get on with the day-to-day operations. Now, that's clearly not the culture that the regulator wants to see. So they want to see executives and the organisation owning outcomes, and they are giving clear examples to everyone of the outcomes that they're seeing and that they regard as good practice versus where they think firms need to shift. Now, I think it's fair to say that the regulator accepts that it's regulation itself that's often driven this culture of tick box. And in fairness to a lot of good firms, the executive have sometimes felt that passing it over to the compliance team and risk teams was the right thing to do, that they were demonstrating the right set of cultural behaviours. But candidly, it's not the compliance teams that run the business. It's the executive team and the people right the way throughout the organisation. So compliance now has an important role to play, but it's not where outcomes-based is focused. It's from the board and actually should be business as usual. It's what good firms are used to doing. It's where they prefer to focus. And frankly, if we get consumer duty right and carry on with the examples that are across the market, then it's going to lead to better business outcomes as well as better consumer outcomes.
Fantastic. Okay, Keith. So what kind of outcomes and measures should individual advisors and firms be looking at to check their implementation is actually on track?
Yeah, great question, Michelle. And I think, and we get a lot of requests from firms on what they need to do next. Now, actually, together with the great thing about running an alliance is it's not about a body called the Consumer Duty Alliance. It's about all of the organisations that now form that alliance. And with over 70 affiliates, many of them provide expert support services across the market where they're giving up their time pro bono. So we've created a free self-assessment tool in association with Model Office, which is available to everyone and anyone to use. And it allows them to do a self-assessment of all the key areas that are expected from an advisor or a firm in particular under consumer duty, and to give themselves a weighted scorecard, so it will come up with a scorecard. And it actually allows them to also use that as evidence to the regulator of how they're testing themselves. Now, the key we're finding with a lot of firms is clearly our key message is don't mark your own homework. So even using a great self-assessment tool that will really help you understand where the regulator is looking or has expectations from a firm, is do use some of the expert compliance services and consultancy services that are available across the market. Doesn't cost a fortune, and they have the expertise really to help you benchmark against what's happening across the market. So for a lot of advisors, it's actually a great investment, given that none of us want to spend huge amounts of time on trying to work out what we need to do when there are experts available that can very quickly help to guide you through what otherwise seems like a bit of a mire. So, without breaking down each bit, I would recommend that firms go on. It's a free tool, and we've deliberately created it to help individuals focus on what's required.
Brilliant, thank you. And what reassurance can you offer advisors that consumer duty is not just another thing to do? Why is it important rather than just being a burden?
Yeah, again, it's great. I mean, I think the FCA have been giving clear messages about this is not a one and done exercise. So really think of this as a real positive cultural shift away from prescriptive rules to an opportunity for the whole sector to own consumer duty outcomes. Now, I mentioned at the start of this that I started my career before regulation came in, and I've got to say I worked for an organisation that passionately thought it was one of the good firms, and that regulation was probably for everyone else, or for a minority that were skewing it for the majority. What we all recognise is there's areas where we could do better. And I think good advisors have always focused on outcomes. It's what they do best, but they haven't always documented it very well. Should actually someone ask for the evidence that they're delivering against their promises or the services that they're offering. And I think what we're now going to see is a positive shift away from these prescriptive rules to really thinking about the outcomes that were expected, which was, I say, frankly, we're already seeing in some areas are leading to better business outcomes. So this isn't rules that, frustratingly in the past, when you're levied with prescriptive rules, I think good firms have often felt that they've been burdened. I think the word you used, Michelle, how can we give that reassurance to advisors that this is not another set of a burden on them to create bureaucratic set of tick box rules that ultimately hinder delivering good consumer outcomes. So, another tray of paper or another set of trees that we've got to chop down to give the consumer in paperwork. No. Actually, improving communications, a better understanding might mean reducing the amount of paperwork we give to clients. That's what outcomes-based rules is about. So sometimes less is more, which I know will be great news for a lot of advisors. It will certainly be great news for a lot of consumers who feel that we chuck them far too much paperwork. So I think we're going to slowly see, with the sharing of good practice across the market, a better understanding that this is a real opportunity to shift back into a more business-focused regulation, because outcomes is all about better business outcomes, because it's better client outcomes. When you're forced into a set of prescriptive rules, it can feel very burdensome and bureaucratic and very frustrating. So I think the message is slowly getting in across the market. This is a real opportunity.
To what extent do you think, Keith, that the narrative has changed successfully from price to value, and how do we continue to do this?
Yeah, I think we are seeing quite a positive change from price to value, but I'd say it's slow. I think there is still a general view that, one criticism that's often levied against the FCA is that it's a price regulator. Firms do often feel that they're constantly trying to attack how much a firm charges. The FCA would argue that they've never been a price regulator, but when they talk about value, of course, the cost of a service or product has to be a key consideration. That's the only, you could argue it's the only tangible. They are accepting that that some value-added services are hard to quantify. So the fact that someone actually might choose to be with one advisor over getting it cheaper somewhere else is because they might have built up trust, they have confidence, and it's hard to quantify that. But we've got to find ways to share, again, experience in the market. Yes, of course, we are seeing some focus where, and I think we're going to see this with closed products, where we've probably been a bit slow to respond, where we might be charging a certain cost of a product that perhaps is not aligned to the benefits that the client's receiving, and that needs adjusting. So there's definitely some focus on downwards pressure on some pricing for products and services, but I'm also seeing some upwards opportunity where firms are becoming much sharper on understanding the real value of what they're adding as a service, and actually they're charging more for it because they've realised that they've been undercharging in the past. So we saw that in the retail distribution review, where many of the experts predicted that 60% of the market was going to disappear because no consumer would pay for advice. What we've seen since the retail distribution review is the average salary of an IFA has over doubled. Once advisors were forced to have to think about what they really added as a value-added service, it was no longer about the product. The value is in the advice you're giving, the tax consideration, other considerations that you can only get through experience and knowledge. And that actually has a value in the cost of the service that you charge against. So I think we're seeing it's slow, but it's forcing us to think now about the real value. I think the initial feeling is, when we talk about price and value, that's a pressure on how much we currently charge. And I think it's fair to do that. But equally, we're missing the opportunity because it's focusing the mind on making sure we focus in the areas where we add the greatest value and making sure that we articulate that to the clients and the future new clients that we need to serve.
What changes are being made in August to increase the span of consumer duty principles? And how will that specifically affect vulnerable customers?
Yeah, it's so we're fast approaching the first anniversary of consumer duty rules, which came in on the 31st of July of last year. Well, on the 31st of July this year, exactly on the anniversary, another two sets of really key changes are coming in place. And that's the first one is that every firm will need to be able to demonstrate an annual either board report, which incorporates all of the outcomes expected. Typically, big firms do an annual strategy review, which of course they include and sign off by the board. Well, that's now got to include all of the aspects of consumer duty outcomes and the cross-cutting rules. For small firms, the key word is proportionality. The FCA are, if you're talking to for example, in the investment advice sector, there's nearly 6,000 firms. 80% of them fall within what's classed as a small firm category. And that means that they've got 5 people or less. Now, if you're a sole practitioner with 2 support staff, you're hardly going to have a board report or a board. So proportionality means every firm should have at least a business plan, and that annual business plan must include how you're delivering against the expectations of consumer duty outcomes. So that's a really key part about the new annual reporting. The second part is closed products and services are now going to be incorporated within the consumer duty rules. So a lot of work there, in particular by many of the big product providers who may have closed products that need to now assess whether they're offering the right set of value, fair price and value, for example, for consumers. So two key changes. For some small advice firms, it's probably not going to be a massive impact, but obviously for some big product providers, certainly there's a hell of a lot of work that's been going on to meet those 2 key deadlines. As far as vulnerability, it's. I think what's happened is we've used the wrong word. So we typically, when we're talking to the FCA, we're helping them understand that whilst the sector sometimes can be criticised for using sector-centric language, so if anyone actually uses an acronym like FCA to a consumer, then they need to be shot, because you shouldn't assume that a consumer knows what the acronym means. But of course we all do, because we use it every day. But our clients and our customers don't. In the same way, the regulator does use, and we've got to help them, I think, in this recognition, they use regulatory-centric language, not sector-centric language. So I've already mentioned, if you say board report to a small firm, that sounds bizarre when you don't have a board of directors and you don't have a monthly board. So changing that terminology around is important. Vulnerability has, we had statistically 49% of wealth managers, just to choose 2 sectors, and 69% of stockbrokers believe that they don't have any vulnerable customers, to the shock of the FCA. But when we say vulnerable customer, most people tend to think about someone with an identifiable disability or an impairment of some kind, in particular age-related. So people in later life lending, for example, recognise they're often dealing with people that are more susceptible to vulnerability through age-related cognitive impairment and so on. Now, if you're a stockbroker, you probably think that you're dealing with wealthy people that are all pretty cognizant. But if you said to a stockbroker, so if someone came to you that was an inexperienced investor versus an experienced, you deal with them the same. And of course they respond and say, no, we have an inexperienced investor process. So right, so you recognise the vulnerability of someone who's got an right, yes, of course we do. Right, well that's what the FCA is saying is a vulnerable customer. And they want you to demonstrate that you've got an inexperienced. So maybe we shouldn't call them vulnerable customers. We should call them customers who need additional consideration or support given the circumstances that they're currently facing or may be facing. So, for example, every firm recognises that if someone came to them and they had just suffered a bereavement in the family, or they were going through divorce, of course, customer service people naturally have an empathy, they sympathise with them, they recognise they might need additional care and support given their circumstances. So again, that's dealing with vulnerability. But if you're a customer service person, you wouldn't want to tag that person as a vulnerable customer. Again, they're people who need additional consideration or support given the circumstances. So I think we've got to change our language. Whilst it's okay to use internal language as vulnerable, and first of all, in some advice firms, they don't use the word customer, they use the word client. So, when you talk to them about vulnerable customer, they argue that they've got none because they've only got clients. But without being too flippant about it, I think it's now understanding that what advisors do often is they help people mitigate potential vulnerable circumstances that they're going to face. And that's what it's about. So, of course, it's about people with an identifiable disability that you should naturally take extra care and consideration about. We're already seeing firms, for example, where people have got a hearing impairment, that they're offering additional services, they're changing the font size, they're changing the way that they communicate with the client to make it much easier for them to understand. They're natural, but the other part of regulation about vulnerability is the circumstances that most people face. And the FCA have assumed that 50% of us will face a vulnerable circumstance within our life. Now, candidly, life triggers, life events, as we've called it in the advice sector, of course occur. And that can often cause a temporary vulnerability for that client at that point in time. That's what the regulator really wants the whole sector to focus on. How do we deal with specific needs of people that are facing certain circumstances? So I think let's change the terminology. It's not vulnerable customer. Don't ever tag anyone as a vulnerable customer. That might be your internal process, but actually, and you certainly wouldn't tell a customer or a client that you've tagged them as vulnerable. You might actually say, we recognise that you're a customer or a client that might need additional help or support. Is that okay? And the chances are they'll say, yes, thank you for considering that. So I think, it's the language, this shift into outcomes-based rather than rules-based, prescriptive rules, does allow us to start to own the dialogue. So we need to move away. And as a sector, the principle of we need to break it down from regulatory jargon to everyday operational language that we're used to using. And that's one of the roles that the Alliance is trying to perform in that sharing of good practice across the market.
Thank you, Keith. And how can we tell if we're interpreting the regulation correctly in the protection industry?
The great thing about the protection industry is, it plays a vital role in delivering the right set of outcomes to protect people against the risks that they face. Now, frankly, I always used to use the term with a lot of my advisors on, it's the family test. When do you ever know that you've got the right level of technical knowledge or competence? Well, if you don't feel confident to ask a question, you should always pause, come back and consult one of your colleagues or peers before you then go back. That's what a lawyer would do as a professional service.
Yeah.
And it's what we would expect someone else to do if they were serving a member of our family. Obviously, a loved member of our family, of course. So it's the family test is really important when you look at outcomes based. So I've just put that in simple terms for any advisor that dials in. But candidly, the tool I mentioned earlier does actually help to give a greater focus on the areas where the FCA will expect firms to be gathering data. And what firms need to understand is they've got to be able to evidence that they're delivering against the outcomes that they say they do. So if they think that they've got a lot of very happy clients, prove it. So it's how do you capture the data that then on demand by the regulator, you can prove it. Now, that's the bit that I think firms are going to feel that it's another load of, it's a burden because they are going to have to kind of think now about using smart technology and other support tools that will help them to capture that data. And we're already seeing a lot of innovation in the market and a lot of sharing of good practice of some software that actually really does enhance the business opportunity that was always there, but strangely enough, until we're forced to do something different, we kind of keep walking by. So I think, I think this is, again, without wanting to sound over enthusiastic about this, is a positive change. It's a far more positive change for advisors across all sectors, candidly, protection and investment, than I think a lot of advisors probably realise at the moment. But it's filtering through, and I think more webinars and podcasts and the sharing of good practice, I think will this time next year, I think we're going to be in a different place again.
As we know, Keith, the introduction of Consumer Duty is just the start. What do you see as the big priorities for the industry in improving customer outcomes moving forward?
Yeah, we're going to see already the big focus now is on a systematic capture of data to be able to evidence outcomes. Firms are recognising that they do need to be smarter at capturing what they do. Certainly getting greater focus now around the use of smart technology. And I call it smart technology because AI is used in such different contexts. But, there is some really good smart technology out there that uses parts of AI to actually, for example, even convert a conversation that an advisor has with a client actually into a report that can then be actually stored, just slightly updated, and that's part of the evidence captured. So without an advisor having to do lots more work, I think we're going to see a much greater focus and opportunity from the use of smart technology. In addition, we will need to develop much greater collaboration between the investment and protection specialists to ensure a more holistic advice service is offered to avoid foreseeable or potentially foreseeable harm. So we're already seeing in the market in certain sectors whether or not making sure that a client is receiving the services against their specific needs is now actually necessitating a rethink, in particular between protection and investment. So as I mentioned, many IFAs have become investment specialists, and perhaps have even forgotten the word protection. So, just because you've got wealthy clients doesn't mean to say that they don't have protection needs. So I think we've got a bit of rethink going on at the moment where the sector as a whole has got to start to own how we shape the future, to collaborate better, to ensure that we can demonstrate that we're delivering better consumer outcomes, better industry outcomes. So I think this is a real opportunity. This isn't just about a set of regulation that's all about not, challenging our price and services against delivering a cheaper service to consumers. It's not that at all. And I think we've got things like the FCA and government's focus on advice boundary, which is all about addressing the advice gap, as a real opportunity to bring the sector together to have a bit of an influence over the future. My final point I'd really say is the regulators already agreed that if they can see the sector shifting culturally towards outcomes-based regulation, it's unlikely that we'll ever see a return of prescriptive rules-based regulation in the future. So this is a genuine opportunity for quite a seismic change for the future.
Thank you, Keith. That's really interesting. And I think particularly music to many people's ears in the protection industry. I think anything that encourages investment brokers to consider protection and understand it is definitely welcomed. It's something we've all been striving for a long time. And my final question for you, and I think something that a lot of our listeners are really going to, and viewers are going to be really interested in, is what top tips can you share with firms who want to make sure they are absolutely compliant with the consumer duty?
Well, first of all, use the free tool. It doesn't take long to invest a bit of time in a bit of self-assessment. Understand where your gaps are. So be honest about your strengths and your weaknesses. And, because a lot of advice firms don't particularly have lots of resource available that are skilled in certain areas, for example, like an analyst or data analyst in particular. And think about investing in buying in some additional expert support that can help you get to where you need to with far greater confidence, that will help you benchmark against the standards. After all, it's what we want more consumers to do. We want them to come to advisors to actually buy the expertise that an advisor has to guide them in choosing the right products to meet their needs. In the same way, I think advice firms just need to do the same. So, what every advice firm should be thinking is there somewhere in their budget an amount of money that they forecast every year to buy in additional services that help them achieve the objectives of improving the services that they offer to meet the requirements of consumer duty outcomes? And I think that's the easy tip I can give you is the self-assessment tool we purposely developed so that it was not a big burden to complete. It's available on www.consumerduty.org. So anyone can go on there and download it for free. But as I say, it's only part of the journey. And the key message from the FCA is as long as they can see that firms have been progressing to meet the rules, is much better than the firm waiting to see what the regulator does next. So in other words, don't sit on your hands. demonstrate the evidence that you move towards it. With confidence, I know most firms already meet the requirements of outcomes-based regulation, but as I mentioned earlier on in another question, it's unlikely that they've been capturing that in a systematic way that could provide the evidence if the FCA come knocking on their door.
Thank you, Keith. That was really useful. I think those top tips are something for firms and advisors to check themselves against. And of course, insurers. And it's not just insurers and advisors. Consumer duty rules apply to. It's everybody in our industry. So that's a great way to close the session. I've certainly learned a lot more about the consumer duty and what it's meant and continues to mean to our industry. And I'm sure our listeners and viewers have found it equally useful. So I'd like to take this opportunity to thank all our guests today. Keith Reichards, Michelle Grant, Jamie Page, and Steve Casey. If you don't already, please follow us on LinkedIn and Instagram. Our Instagram address is IP Task Force UK. Don't forget to note your CPD points, and please feel free to share this session with anyone and everyone you feel will benefit. A recording can also be found on our website, iptf.co.uk. Thank you very much for joining us.